New study finds that used cars are more expensive now than this time last year.
According to Fitch Ratings, more Americans are falling behind on their car payments after a sharp decline in the midst of the pandemic.
Flooded cars often end up in salvage yards like this one. But an estimated 500,000 of these damaged vehicles are still out there driving around. The owners might not even know it.
Have you noticed how dealerships that once begged you to buy their cars have suddenly gone silent? Or how trade-in values that seemed sky-high just months ago are now crashing down by the thousands? Something big is happening in the used car market, something most Americans haven't seen in their lifetime. The only question now is whether you'll be one of the millions caught in the collapse or one of the few who turn it into the deal of a lifetime. Across America, millions of people are about to see their car values plummet. While many drivers will lose thousands of dollars, others could end up finding the deal of a lifetime. Experts warn that approximately 3 million used cars are set to hit the market simultaneously, and this massive influx is being referred to as a used car disaster in the making. This moment is more than just prices dropping. It represents a significant shift in money and opportunity. Buying at the wrong time could trap someone in crushing debt, while buying at the right time could mean saving a fortune. Dealerships everywhere are holding on to too many vehicles that continue to lose value. Think of it as a giant clock ticking down, waiting to explode. When it finally does, prices will not slide slowly, they will fall sharply. Take Jason, a welder from Detroit, as an example. Just 1 year ago, he paid $64,000 for a Ford F-250. Not long ago, he passed by the same dealership and saw the same truck, same year and trim, listed for $51,000. That is a loss of $13,000 in just 12 months. Stories like Jason's are only the beginning. The flood of cars waiting to hit the market is too large to ignore. The pressure is building fast, and once it bursts, buyers and owners alike will face the shock. What makes this situation even more serious is what is happening behind closed doors. So the big question is straightforward. Why are millions of cars suddenly about to show up in the market all at once? And why has the average driver not been warned about it? For the past 3 years, the used car market has been nothing short of crazy. Prices didn't just rise a little, they exploded. A 2020 Ram 1500 that sold for $35,000 back in 2019 suddenly jumped to $48,000. Even everyday cars, like the Toyota Camry, were increasing in value instead of decreasing, gaining worth simply by sitting in a driveway. This was not just unusual, it was unheard of. Cars stopped being treated as everyday expenses and began to be seen as investments. The average monthly payment for a used car shot up to $733. Think about that for a moment, $733 every single month. Not for a new vehicle, but for one already used. In some parts of the country, that is the exact cost of a house payment. This upside-down reality rested on 3 major supports. First, the supply chain meltdown that strangled new car production. Second, the extremely low interest rates made risky loans appear more attractive. And third, rental car companies that refused to sell off their fleets, keeping more cars off the market. However, all 3 of those supports are now crumbling simultaneously. The supply chain has cleared up, interest rates have surged, and rental car companies are rushing to unload vehicles faster than a teenager trying to erase their browser history before getting caught. Yet, even with all that happening, there is another hidden factor that few people are talking about. Dealerships are aware of it, but they don't want customers to catch on. The sudden collapse in the used car market is not being caused by just one thing. It is the result of several forces converging simultaneously: financial pressure, industry changes, and shifting consumer behavior. One of the most significant problems is happening right on dealer lots. Most people assume that dealerships fully own the cars sitting outside their showrooms, but that is not the case. In reality, most dealers utilize a financing method known as floor plan financing. This is an extensive credit line that enables them to maintain a steady supply of vehicles on their lots. A dealer principal from Wisconsin who did not want his name revealed described the situation in simple terms. He explained that every car on his lot cost him about $30 a day in interest, with 100 vehicles in stock, which adds up to $3,000 every single day. When cars sold quickly and prices continued to climb, this system worked. However, with cars sitting on lots for 90 days or more, those costs accumulate to nearly $3,000 for a single vehicle. That kind of expense forces dealers to sell cars at a loss to stop the financial bleeding. The trouble does not end there. When car values start dropping, banks and lenders begin to worry. They send out inspectors to check dealer lots and often demand immediate payments to cover the difference between what the cars were initially financed for and their current value. These sudden demands, known as margin calls, are happening all across the country. Many dealers do not have enough money to pay them. The Wisconsin dealer explained that 3 dealerships he personally knows have already shut their doors and turned over their keys to the bank. He compared it to the 2008 housing crisis, except this time it is hitting car dealers instead of homeowners. But dealer struggles are only part of the story. A significantly larger wave is building in the repossession market. Across America, about 15,000 cars are being repossessed every single day. To put that into perspective, while you watch this video, about 175 families will lose their vehicles. By the end of the day, the total will have climbed back up to 15,000. Behind every repossession is a real story, not just a number on a chart. When cars are repossessed, they do not simply disappear. They are shipped straight to auctions, where they join a mountain of other vehicles already flooding the market. And repossessions are only the first part of the problem. The second wave is coming from lease returns. In 2020 and 2021, leasing was extremely popular, with millions signing 3-year contracts. Those leases are now ending all at once. The banks that finance them are worried because the vehicles are worth far less today than they originally predicted. A banker in Chicago explained that they are seeing a 30% gap between the values they expected and what the cars will actually sell for. That adds up to billions of dollars in potential losses. The banks will not shoulder those losses. Instead, the burden will fall on consumers through lower trade-in offers and tougher financing terms. And there is still more pressure building. Rental car giants like Hertz, Enterprise, and Avis usually sell around 2 million cars every year when they refresh their fleets. During the pandemic, they held onto their vehicles longer than usual as replacements were impossible to obtain. Now they are unloading massive numbers of those cars all at once. A wholesale auction manager in Texas described it not as a trickle, but as a flood that the market cannot absorb. When too many cars hit the market at the same time while fewer people are buying, prices do not just fall a little, they crash hard. That is the stage the market is currently heading into. There is a dark problem spreading quietly through the used car market that most people have never heard of. These are flood-damaged vehicles, often referred to as zombie cars, and they are far more common than most realize. In the last 2 years, record-breaking floods have destroyed hundreds of thousands of cars across the United States. Hurricane Ian alone left around 40,000 vehicles submerged in Florida. Severe flooding in Kentucky, Missouri, and California added tens of thousands more. While many of these cars were marked as total losses and scrapped, a large number slipped through the cracks. More than 45,000 of these damaged cars have been given clean titles and are now being sold in the used car market as if nothing ever happened. Frank, a car inspector from Georgia, explained how this happens. He said the cars are dried out, new carpet has been installed, the electronics have been cleaned, and strong deodorizers have been sprayed throughout the interior. To the average buyer, the vehicle appears to be in perfect condition, but within months the problems begin. Mold spreads through the ventilation system, hidden rust eats away at the metal, electrical systems fail, and brake lines corrode from the inside. What seemed like a great deal quickly becomes a safety nightmare. As if hidden flood cars were not enough, another threat is rising in the form of frozen financing. This financing freeze creates a dangerous trap for both buyers and sellers. Sellers and dealerships are left holding vehicles they cannot move, forcing them to slash prices even further. The cycle feeds on itself and deepens the crash. Together, zombie cars and frozen credit paint a troubling picture. Families risk buying vehicles that look safe but hide expensive and dangerous flaws. Others risk being locked out of the market entirely, even as prices around them fall. The market is not just softening, it is becoming a minefield where every decision carries hidden risks. For consumers, this creates a double blow. Legitimate vehicles lose value at the same time the market fills with dangerous cars disguised as reliable transportation. According to some insiders, even these grim forecasts may be overly optimistic. Ryan, who runs a mid-sized dealership in the Midwest, offered a blunt assessment. He said that this is no longer a correction, but a bloodbath. In his 22 years in the industry, he has never seen inventory levels build to the extent they are now reaching dealer lots. The impact is not limited to car lots. Nearly 40% of new car dealerships depend on profits from used vehicle sales to survive. What begins as a used car problem quickly spreads into a broader economic issue that touches entire communities. At the same time, the financing pipeline that fuels the auto industry is freezing. More than 85% of new vehicle purchases and nearly 60% of used vehicle purchases rely on loans rather than cash. When lenders raise interest rates, tighten credit requirements, or refuse approvals altogether, the flow of buyers dries up instantly. It is not simply a slowdown, it is a complete stop. Vehicles can stack up on lots, but without financing, they may be unsellable. Industry data shows that nearly 40% of Americans with car loans are now underwater, meaning they owe more on their vehicles than those vehicles are worth. That percentage continues to rise every month as market values decline. The trap is clear. Owners cannot trade in without incurring a significant financial loss, but keeping the car does not solve the problem either because the loan balance remains stubbornly out of sync with reality. This paralysis slows down new car sales, clogs dealer lots with used inventory, and accelerates the downward spiral in values. Yet in every collapse, there are two sides: those who get crushed and those who quietly position themselves to benefit. Because in markets, wealth rarely disappears. It simply moves from one group to another. The winners in this downturn will be the cash buyers. They will walk into dealerships with no trade-in weighing them down and no financing hurdles to clear, and they will negotiate prices that seemed unthinkable just 2 years ago. The patient buyers will also come out ahead, especially those who wait until late 2025 or early 2026, when analysts believe the bottom will finally be in sight. Others will take a counter-cyclical approach, buying vehicles that have fallen out of favor, such as sedans, which will be available at fire sale prices. At the same time, most attention remains focused on trucks and SUVs. The losers, on the other hand, are already being written into the story. Owners of luxury SUVs, full-size trucks, and high-priced models such as Escalades, Yukons, and F-250 Limiteds are likely to face value drops of 30 to 40%. Mid-size SUVs and trucks, including popular models such as the Highlander, Pilot, Edge, and Colorado, could see a 20-25% decline. Even the smaller, fuel-efficient cars that typically hold value better than the rest are projected to dip by 12 to 15%. The dividing line between winners and losers is timing. Move too early and you risk catching a falling knife, buying a vehicle that loses thousands more in value within months. Wait too long and you risk missing the bargains as the market begins to recover. The decisions made over the next 18 months will determine whether car buyers get trapped in years of financial pain or walk away with once-in-a-generation deals. Remember what I said at the very beginning? While millions of Americans are about to be crushed by collapsing vehicle values, a smaller group could be setting themselves up for the automotive deal of a lifetime. That was never hyperbole. It was both a warning and an opportunity. The used car apocalypse is not on the horizon. It has already begun. An estimated 3 million vehicles are about to flood the US market, and values are already sliding at a pace most Americans have not yet recognized. What is unfolding is neither a dip nor a correction. It is a full-scale collapse, one that will strip wealth from the uninformed and quietly transfer it to those who saw the signs and prepared. If you found this breakdown valuable, hit subscribe and turn on notifications. This will not be the last market collapse we cover, but it might be the one that finally puts money back in your pocket instead of draining it. Are you planning to buy a vehicle within the next year, or are you waiting for prices to drop further? Share your situation in the comments. Your experience could save someone else thousands of dollars. We'll see you in the next video.